Good day, folks. Are you looking to make your first purchase? Well, there are some key definitions that you really need to understand in the mortgage industry, and I'm going to break them down for you in a very simple term. It's Rayon Gillespie here, your senior mortgage consultant and financial literacy advocate. And today we're going to talk about what are these key definitions that first-time home buyers need to know. But first, let's start with our quote of the day. Our quote of the day is this: you're never too young or too old to pursue your dreams. So let's pursue our dreams of home ownership and look at these fundamental definitions. First is down payment. What kind of down payments are out there, Rayon? Well, you got two down payment typically when we look at buying a house. Your first one is a conventional down payment, meaning you're putting down 20% or more. Your second one is when we're looking at a high ratio mortgage, meaning you're putting down less than 20%, but a minimum of 5% on that mortgage. The other thing to understand here about high ratio mortgage is that there is what we call a default insurance premium. Yes, you need to buy a separate insurance that actually protects the mortgage should there be a default. This insurance is out there to protect the banks, all right? So it's very important to know that you have, as borrower, does not benefit at all from this kind of insurance. The other thing to understand is this: the high ratio insurance costs, if you're looking at buying one unit and you're putting down your 5%, typically you're looking at a 3.85% fee, which is then added to the mortgage, the total mortgage. So you don't have to pay it up front. All right, that's important to understand. The other thing is this: amortization. What's the amortization? Well, you know what? The amortization is very simple. Basically, it's the total number of years that will take you to pay off the entire mortgage. Typically, when we're speaking, depending on your down payment, your amortization comes with that. So, for example, if you're putting down 20% or more, you can go up to borrowing off 30 years. If you're putting down less than 20%, you're maxed out at 25 years amortization. All right, so that is very important to understand. And what about term and rates? Well, we're gonna get to that. Basically, your term is typically a contract that is anywhere between 6 months to 5 years. Now, just so you know, you can go much longer if you want. You can go up to 10 years, but keep in mind that you don't wanna lock into a rate for too long because you might miss out on certain benefit. Economic cycle benefit. Usually every 5 years or so, there is an advantage in terms of rate, typically, historically speaking. And so you don't want to lock in for too long. Again, circumstances do changes in your social factor. So you might want to look at consolidating some debt in the next few years. So you want to avoid locking for 10 years because then you might have to pay a penalty for breaking. All right, so that's important. Now, let's look at your rate. Now, in terms of your term, you have an open term, you have a closed term. An open term basically is not contractual. It's an agreement which you can break at any time. Typically, those that are looking to sell their home within the next 6 months or so, if they're into renewal, you might not want to lock in, if you're looking to sell in the next few months, you want to avoid that prepayment charge, all right, which is important. Now, obviously, your closed term is a contract, which means that you're buying to that contract for the period of time that the term is. So if it's a 5-year term, you're locked in for 5 years because you're getting a special interest rate. If you decide to break that term, you get a penalty, a prepayment charge, typically around 3 months interest, okay? So that's how it normally works. Now, let us look here at some advantages. What's the advantage of a fixed rate? The advantage is that security that you're getting. You're getting that security to keep your payment for X amount of time, and you don't have to worry about the rates going up. Whereas with variable, the rates do tend to fluctuate. And which one's better? Should I go variable or fixed? Now, historically speaking, variable rate has always been more competitive. In our recent market environment, we know that the Bank of Canada has increased interest rate a few times since June. And guess what? They're looking to do it again. And why, Rayon, you might ask? Well, the rate is increased based on the spending habits of Canadians. So the Bank of Canada basically review its rate every 3 or 4 months, and you know, they'll increase the rate if they see that spending habits are getting out of proportion. We want to stay between a 2 to 3% annual inflation rate, and so once we typically see a projection that's even over 2.8, the bank's going to put the brakes on it, put the rates up, and cause us to spend less. All right, so that's how that worked. Now let's move on here to something else that is crucial. Thanks for your patience, folks. You know, people ask me, they say, Ray, why don't you use technology? I'll tell you this, I'm old school. I like to put the work into what I do. All right, and so I'll take the time and write with different colors because I really enjoy doing it. And this is how I choose to do things. So your TDS and your GDS, basically, it's there to determine if you, the borrower, can afford your potential mortgage. All right? Now, what do we basically look at when we look at GDS and TDS, which is your gross domestic service ratio, and your TDS is your total debt service ratio? And basically, we divide the gross annual income by your expenses here, your credit card monthly, your monthly loan payment, your monthly heating costs, your property tax, and your principal and interest, actually, in terms of a mortgage payment, does come into tie. Now, how this GDS, TDS work is this. It's based on a percentage. And in other words, the rule states that if you make $1, you should not owe more than 44 cents. All right, so that's in very simple term how to break down this rule. The TDS cannot go over 44% and the GDS cannot go over 39%. Come talk to me, we can go deeper into this, all right? Now, what about the loan to value? Rayon, what is this loan to value that I've been hearing? I own a house and, you know, I've had it for a while and, you know, I got some credit card bills to pay. Well, that's where your loan to value comes in, because basically it's the amount of loan in dollar percentage, okay, in relation to the value of the property. So we want to stay around a healthy 80% loan to value. We don't want your property, the value in terms of debt added to the property, be over 80%. So we want to stay healthy. We want to keep Canadians within their budget. If you are going through some financial hardship, please come by. Inbox me, give me a call. I would love to sit down with you for a complimentary review just to make sure that you're going in the right track, all right? So basically, this is what I wanted to talk to you about. The equity takeout is there to consolidate your debts. Credit card bills are high, folks. If you know you have a credit card bill, take care of it, get rid of it, consolidate it into a smaller interest, and you'll realize how much more money you're saving per month. You have a great day. I have some wonderful videos coming out. We're gonna talk about what is insured mortgage, what is uninsured mortgage, and what is insurable mortgage. Some great things coming ahead, folks. You have a blessed day.